If 40% of your money is tied up in just 10 companies, you're not actually diversifying, you're flat out gambling, and most people don't even realize it. The biggest fortunes are lost not when the market crashes, but when people convince themselves, "This time I'll make it," and blindly latch onto a single trend. Throughout history, every major technology wave, railroads, automobiles, the internet, has told the same story over and over. A handful of companies pull ahead, everyone rushes in, prices inflate far beyond what's real, then the bubble bursts and only the prepared survive. In this video, I'll walk you through how market index funds actually work, why they tend to carry increasing concentration risk over time, and how to protect yourself against it. And I'll also share 4 core strategies that investors commonly overlook. Stick around to the end and you'll walk away with a framework that protects you no matter what the markets do, so let's get into it. Most people assume that when they invest in an index fund, their money gets spread evenly across hundreds of companies, but that's usually not the full picture. Because in funds weighted by market capitalization, the biggest companies take the biggest slice of the fund, meaning the larger a company grows, the larger its share of the fund automatically becomes. This isn't a problem in a healthy market because power is distributed across different sectors and companies. But when the market becomes overly fixated on a single theme of a given era, one technology, one sector, one narrative, things change. In the past, it was coal companies. Then it was the railroads, then the oil giants, then dot-com-era tech companies. The same pattern repeated every time. Investors told themselves, this technology is going to change everything, so price doesn't matter. And those technologies really did change the world, but most of the companies that drove that change still lost their investors' money because prices had drifted too far from reality. We need to stop here and ask why this kind of concentration is so dangerous in the first place. After all, those big companies really are valuable. They really do generate earnings. The problem isn't the companies themselves, it's the risk distribution you're exposed to. The entire point of diversification is to prevent a single event, a single development in one sector, a single technological disruption from hitting your whole portfolio at once. If the bulk of your money is concentrated in a small number of interconnected companies all betting on the same theme, then even though it looks spread across hundreds of companies on the surface, in reality you've become dependent on a single scenario, and that strips away the most fundamental protection diversification is supposed to offer: the assurance that, if one thing goes wrong, the rest will keep me standing. Let me unpack this a bit further because this is really the most critical point to understand. A company being successful and the people who invested in that company making money are not the same thing, and conflating the two is one of the most common traps investors fall into. Take the railroad example. In the 19th century, railroads genuinely changed the world. They accelerated trade, connected cities, transformed economies. As a technology, it was a tremendous success, but most of the people who invested in railroad companies at the time still lost their money because far too many companies were founded all at once. Competition eroded prices, and shares bought on wildly optimistic expectations climbed to many multiples of their real worth. In the end, out of hundreds of railroad companies, only a handful survived. The same pattern repeated a century and a half later with internet companies. The internet really did change the world too. Today we all talk through it, shop through it, work through it, but nearly all of the thousands of internet companies founded in that era went bust, only a small handful. The few giants we still know today survived and delivered extraordinary returns to their investors, so the technology was right, but predicting in advance which company would win was nearly impossible, which is exactly why a little alarm should go off in your head every time you hear the phrase, "This is the technology of the future, so price doesn't matter." Have you ever wondered whether one of your own investments might be inflated by, "This time it's different"? Thinking, write it in the comments. I genuinely want to know because recognizing this pattern might be the single most valuable lesson you can learn as an investor. And here's the easiest way to spot it. If you're buying an asset purely because its value keeps going up, and you can't explain what it actually produces, what it actually earns, or why it's worth that much, you're probably chasing a narrative, not the numbers. Now let's look at how to protect yourself against this risk, because the solution isn't stay completely away from this trend. Nobody can know in advance which company will win, and staying entirely outside major trends carries its own risk. The real issue is finding balance. I use 4 core strategies to build that balance, and I'll now walk through each one and explain why it works. The first strategy is geographic diversification, because history shows us that no country holds on to economic leadership forever. A century ago, when the empire considered the world's financial center was at the height of its power, no one could have imagined it would decline. If you'd told an investor back then, In 100 years, this country won't be the leader of the global economy anymore. They would have laughed at you because everything seemed so permanent. Finance, trade, industry, all concentrated in a single center. Yet within a few decades, the global picture had completely changed. Then a similar story played out on another continent. A country rose so rapidly in manufacturing and technology that the experts of the time predicted it would soon sit at the top of the global economy. Investors poured in, but within a few decades, that country's growth story slowed too, and leadership unexpectedly changed hands once again. This cycle repeats in every generation because economic power isn't fixed, it's fluid. Demographic shift. Technology changes hands, policies diverge, new generations of companies are born in different geographies, which is why investing only in your own country's companies, no matter how strong they look, leaves you outside this natural cycle. To make this concrete, think about it like this. When you insure your house, you don't do it because you think your house is going to burn down. You do it to protect yourself against a low probability but devastating scenario. Geographic diversification works exactly the same way. There's no guarantee that today's strongest economy will still be the strongest tomorrow. Investing in a globally diversified fund automatically lets you keep pace with that shift. Whichever country or region comes out on top, without you having to do anything, the fund rebalances itself. The share of a strengthening region grows, the share of a weakening one shrinks, so you're never tied to the fate of a single country. I also want to address an objection I hear often. Some people think, but my country's companies have historically performed best. Why would I look elsewhere? That's a reasonable question, but here's what gets missed. Past performance is never a guarantee of future performance, and an economy staying on top for a long time doesn't mean that leadership will last forever. In fact, the longer an economy stays at the peak, realistically speaking, the more the odds of that peak continuing actually decline statistically, because every economic cycle has its own lifespan. Demographics age, competitive advantages erode, new technologies are born in different geographies. This isn't pessimism, it's simply a pattern. History has shown us again and again, which is why "it's always been this way" is one of the most dangerous sentences in investing, because the past is not a guarantee of the future, only one possibility among many. The second strategy is balancing between large and small companies, because when a technology or trend matures, the winner usually isn't the giant company that first invented it. It's the smaller, more agile companies that apply it most intelligently and efficiently in everyday life. Think about it: when a new product category emerges, a handful of major players dominate the market. At first, everyone knows their names, the media talks about them, investors flock to them, but as competition increases over time, prices fall, quality levels out, and customers stop caring which brand is most advanced and start caring about who delivers the same value at a better price. At that point, the big players' profit margins shrink while nimble, smaller companies gain market share. Let me explain this with an everyday example. Picture a gas station. One station sells its fuel at a premium. Because it claims to be higher quality, the station right next door sells nearly the same quality for much less. At first, maybe a few people choose the pricier option, but over time, as people realize the quality gap is barely noticeable in practice, they shift to the cheaper choice. The same process plays out with technology companies. Once a technology matures and standardizes enough that everyone can offer a similar level of quality, competition shifts to price and efficiency, and that favors small, flexible, low-cost companies over large, sluggish, high-cost ones, which is why it pays off in the long run to make room in your portfolio not just for the giants of a sector, but also for the small and mid-sized companies that use the technology those giants created cheaply and intelligently. Investing in smaller companies can also mean picking up tomorrow's giants while they're still cheap, because nearly every one of today's giant companies was once a small, unknown company itself. At this point, some of you might be asking, aren't small companies riskier than large ones? And that's a fair observation taken individually. A small company is more fragile than a large one. It has less cash reserve. It's more vulnerable to competition. Its odds of failure are higher, but the key word here is individually. If you make one big bet on a single small company, yes, that's risky. But if you invest broadly across hundreds of small and mid-sized companies through a diversified fund, the picture changes completely, because a handful of failures among those hundreds won't sink your portfolio, while a handful of them turning into giants over the next decade could carry the returns of your entire portfolio. Statistically speaking, outsized returns usually come from a small number of companies, and instead of trying to pick those winners individually in advance, investing in a broad basket of small companies lets you automatically capture those potential winners. How much room do you give small companies in your portfolio, or do you always lean toward the big names? Write it below. It'll help other viewers compare notes too, because the most valuable discussions on this channel usually happen in the comments, in what you share with each other. The third strategy is allocating a small share to hard assets, things like gold, that have historically held their value against inflation and currency fluctuations because paper currency systems have lost value time and again throughout history in wars, economic crises, periods of excessive money printing. A country's currency can lose much of its purchasing power overnight. This has happened repeatedly throughout history, but here's the interesting part. In none of those crises did gold's value go to zero. On the contrary, whenever people lost trust in paper money, they consistently turned to the same place, that yellow metal that has held its value for thousands of years, which is why major financial institutions and central banks always keep a small percentage of their portfolios in these kinds of assets. The goal isn't to get rich, it's to buy insurance. Just like you take out fire insurance on your house, you hope you'll never need it, but you still get the coverage. Gold plays exactly that role in a portfolio. It generally acts as a balancing force when your other assets are losing value, because investors avoid risk during periods of uncertainty and flock to safe havens, and gold has historically been one of those safe havens. I want to underline an important point here. Allocating to hard assets doesn't mean converting half your portfolio into gold. On the contrary, this should generally be a small strategic share, because gold doesn't offer the same growth potential over time that company stocks do. Its job isn't to grow, it's to protect. Understanding that distinction really matters. You rely on stocks for growth and on hard assets for protection, and if you confuse the two and assign them the same role, you won't fully achieve either goal. To put this in more historical context, throughout human history, countless currencies, the currencies of countless empires, have come into existence, and nearly all of them eventually became either completely worthless or lost most of their value. The reason was usually the same. When a state starts printing more money to cover its spending, as the money supply in circulation grows, the value of each unit falls. This process sometimes happens slowly, sometimes very quickly, but the outcome was usually similar. Paper-based monetary systems can be affected by political decisions. Hard assets, because they're physically limited, are far less affected by those kinds of decisions, which is why for thousands of years humanity has consistently turned, in periods of uncertainty, to the same place, assets with limited supply that no one can arbitrarily multiply. This isn't a coincidence, it's a recurring pattern in human behavior throughout history. The fourth and perhaps most overlooked strategy is maintaining an adequate cash reserve, because even though markets rise over the long run, sharp short-term declines always happen. And those declines often coincide with the times when people are going through a difficult period in their own lives, a job loss, a health issue, an unexpected expense. If you don't have enough cash on hand, you're forced to sell your investments at exactly the worst time, when prices are at the bottom, and that does irreversible damage to your long-term savings. Let me unpack this a bit further, because this topic doesn't get covered enough in most investing videos. Imagine the market drops 30%. Your shares lose the same percentage of value. Under normal circumstances, that's not a problem. Because markets recover over the long run, if you stay patient, your loss stays on paper. It never becomes real. But what if right at that moment you lose your job or an unexpected medical expense comes up? If you don't have cash on hand, your only option is to sell those devalued shares, meaning the market forces you into the worst decision at the worst possible moment. An adequate cash reserve is exactly what prevents that. It buys you time, and time is the most valuable resource in investing, because markets always need time to recover. On top of that, having cash on hand doesn't just protect you, it also lets you take advantage of opportunities when the market drops. A common trait among history's most successful investors is holding cash while everyone else is panicking. They're patient while waiting, and they move quickly when the opportunity arrives. When the market drops, shares of quality companies go on sale too, and if you have cash on hand at that moment, while everyone else is selling out of fear, you get to buy solid companies at a good price. That's exactly the behavior that builds wealth over the long run, staying rational at the exact moment everyone else is afraid. At this point, you're probably wondering, okay, so how do I actually balance these four strategies in practice? How much should stay in my main growth vehicle? How much should go elsewhere? There's no single number that fits everyone here, because it depends on your age, your goals, your risk tolerance, and the financial obligations in your life. A younger investor, someone with a long runway to retirement, can naturally lean more heavily toward growth because they have time to ride out market swings. Someone approaching retirement or planning a major expense in the near future will likely need more balance and protection. What matters isn't memorizing exact percentages. It's understanding why each of these four elements exists in the first place, because once you understand the principle, you can adjust the balance yourself according to your own life circumstances. Rather than handing everyone a copy-paste formula, I'd rather teach you to fish. Now, if we bring all of this together, a real investment strategy comes down to not being overly dependent on a single trend, a single country, or a single asset class, while keeping the majority of your portfolio in your main growth vehicle, adding geographic diversity, room for smaller companies, a small share in hard assets, and an adequate cash reserve puts you in a position that benefits from growth while staying resilient against potential shocks. I also want to add that these four strategies aren't independent of each other. They actually form a complementary whole. Geographic diversification protects you from being tied to the fate of a single economy. Room for small companies gives you the chance to catch tomorrow's giants while they're still cheap. Hard assets give you a balancing factor in moments of crisis. And a cash reserve gives you both security and the flexibility to act in moments of opportunity. When these four come together, what you end up with isn't a single bet. It's preparedness across different scenarios, and that distinction really matters because the long-term winners in markets usually aren't the people who made the most accurate prediction. They're the people who stayed standing no matter which scenario actually played out. I should also mention, none of these four strategies can fully protect you from market volatility. No strategy can. There's no such thing as risk-free investing, and I'd recommend staying away from anyone who promises otherwise. The goal of these four strategies isn't to reduce losses to zero. It's to make losses manageable, to protect you from a single bad scenario completely wrecking your financial life. That's a subtle but important distinction because people who enter the market with unrealistic expectations tend to panic and sell at the worst possible time during the first serious downturn, while people who enter with realistic expectations, knowing that volatility is normal, manage to ride out the storm and benefit from long-term growth. Remember, the real winners in the market aren't the ones who make the smartest predictions, they're the ones who manage to stay in the game the longest, and the secret to staying in the game is staying disciplined even in exciting times. No matter how appealing a trend looks, no matter how convincing a narrative sounds, sticking to the core principles, diversifying, maintaining balance, staying patient protects you from major losses over the long run while keeping you positioned to take advantage of real opportunities. Did watching this video give you a chance to reconsider your own portfolio? If this framework was helpful to you, you can let me know by hitting the like button. If you notice something missing or see things differently, definitely say so in the comments, because this channel is genuinely shaped by your feedback. If you share where you are in your own investing journey or which strategy you'd never considered before, in the comments you'll also be lighting the way for other viewers walking the same path. Maybe something you share will keep someone just starting out from making a big mistake. That's really the strength of this channel, less a one-way broadcast and more a community we learn from together. In the end, markets will always be uncertain. That's the one thing that will never change, but being prepared for that uncertainty is in your hands. The small steps you take today, diversifying, staying patient, staying disciplined, will carry you years from now to a place that both benefits from growth and stands resilient against the storms. In the next video, I'll go into more detail on how to put these four strategies into practice and which tools can make it easier, so if you want to see more content like this, make sure to subscribe to the channel. See you in the next video.